Hey there, welcome to Kneppy Invest. Time to look at the performance of three portfolios that we have been tracking since the start of the financial year. And times have been tough the last few months. And it's pretty obvious when you see the returns out of the group portfolio and one of my own personal portfolios, you can see how highly correlated the performance of those two portfolios are to the overall sentiment in the market. When the overall sentiment is quite positive, these portfolios will tend to overperform the market. But when the overall sentiment is negative, the complete opposite, they will tend to underperform the market. And during the past few months, we have seen the sentiment in the overall market shift from being positive or maybe even neutral to definitely being negative. And we have seen significant deterioration in the performance of two of the portfolios I'll be looking at in this video. For those who haven't seen one of these videos before, I do an update to the performance of these three portfolios every single month. The group portfolio is a combination of about 25-30 companies that were chosen by the viewers of this channel before the start of the financial year. No trading in that portfolio, so completely passive strategy. And that sort of strategy can work. Sometimes it might struggle, and right now it is struggling, short-term struggle, but I expect when the market does turn around, become positive again, we'll see the group portfolio significantly outperform the market. And I will also be tracking, or am tracking, two of my own personal portfolios using different strategy. One of those strategies is the sort of strategy I've always used as an investor. That's a strategy I started using, and that's just finding companies I think will be good investments for the long term. And when I talk about long term, I'm talking over 10 years. So I buy into these companies and hold those companies as long as possible. And the only reason I might sell out is if the story of that company changes. And the other strategy portfolio that I am tracking is based off a strategy that I've developed over the past few years, and it's still evolving as I speak. And it's centered around more technical aspects of investing or speculating or trading, and really looking at sentiment in individual companies. So it also takes into account the overall market sentiment, but this is just looking at short to medium term sentiment, because the main driving force of the share price of companies is sentiment, particularly in the short term. And I have found this strategy works quite well for me, maybe because it really suits my personality. Before we turn attentions to the performance of the three portfolios, usually I just have a look at where the overall market is now. This is the monthly chart of the XJO, so that is the top 200 companies on the ASX. And this goes all the way back to 2002, so a 20-year chart here, monthly chart again. And the reason I'm looking at the monthly chart is because I'm doing this update every single month, and we have quite a few lines on this. So two of the non-straight lines are just the moving averages, which is the 50-week and the 100-week moving average. And we do see the XGO remain in uptrend throughout this 20-year period. And that's what you want to see over the long term. You want to see the stock or the overall market in an uptrend over the long term. And that means that sort of long-term buy and hold strategy could work, particularly if you buy into ETFs, those sort of things, because over the long term, the market goes up. Now, during certain periods within this 20-year period, we have seen the market take significant tumbles, particularly during the GFC, where the XGO tumbled from, about 6,800 all the way down to 3,200. During the COVID-19 financial panic, we saw a bit of a flash crash, a very short term, I think it was a 1 month crash in the market, but it rebounded fairly quickly. And ever since the end of the GFC, the XGO has been trading in this channel, and that channel is depicted by these two sloping orange lines. We've also got a long-term trend, and that is right on the bottom, a sloping blue line. And whenever the XGO gets to that uptrend, that is the time probably to go all in. We saw the XGO reached the uptrend during the bottom of the GFC, and also it almost reached it during the COVID-19 financial panic. So that uptrend right at the bottom of the financial panic, of the COVID-19 financial panic, was around 4,300, and the SGO got actually to 4,400. My buy-in or all buy-in price at that point in time was around 4,000. I was being a little bit too pessimistic, and I think I should have, probably my biggest mistake during the COVID-19 financial panic was having a buy-in price being a little bit too pessimistic. I thought the market would, because of the panic, would probably overshoot that uptrend. But that was probably the biggest mistake I made at that point in time, because I didn't go all in at the bottom of the COVID-19 financial panic when I probably should have. So that's probably the low point, is that uptrend, long-term uptrend. We don't want that to be broken, because that would be probably the worst news we could experience in the market. So at this point in time, the XGO is in the top end of the trading channel. So even though there's a fair bit of negative sentiment in the market right now, when you look at the long term and the monthly chart, still a lot of positive sentiment. So if you look long term, no reason to go all to cash right now. Before we have a look at the performance of the group portfolio to current date until the March the 4th, let's just go back 1 month ago to see how the group portfolio was performing at the end of January or the start of February. And this is the group portfolio, all companies in it. And the most significant feature of the group portfolio is how most of the heavy lifting, if not all the heavy lifting, was done by a select few companies. So only 3 companies in this group, about 30 companies, had seen massive gains. And those companies were Brainchip, up over $10,000, Novonix, up about $8,000, and Lake Resources, up about $6,600. And funnily enough, the majority of companies in group portfolio were actually down since the start of the financial year. The only reason why the group portfolio was significantly beating not only the market, but also was in massive profit at this point, over 10% gains, was because of those 3 companies. And that's all you need to happen in your portfolio, is you just need a few winners to see significant gains, because the maximum you could lose in one company is 100%. You can't lose any more than that. And the maximum you can gain in a company is infinite. It can be 100,000%. Who knows? So that's why this sort of strategy, buying a group of companies, say 30 companies or so, and just holding for the long term, why that can work, because all you need is a few companies to go wild, to increase by 10,000, 100,000%, and your portfolio will outperform the market without doubt. February was not kind to the group portfolio. So now, instead of being up $10,000, the group portfolio is now down $1,810.85. Thankful for dividends. The group portfolio did receive $1,500 dividends so far since the start of the financial year. So if you just look at capital gains, the portfolio is down over $3,000. Still, the majority of the heavy lifting is being done by those 3 companies, Lake Resources, Novonix, and Brainchip. But now, Lake Resources is the best performing company, up $7,800. Novonix is only up $5,000, and Brainchip share price has fallen off a fair bit and is only up $5,000. Brainchip share price at the end of trading on March the 4th was $1.11. Only 4 other companies in the group portfolio were in the black, and that includes BHP, which did receive $562 in dividends, so the capital gains there was quite low, and also Fortescue, up $13.27, but that's because of dividends again. Dividends received $547.33. Every other company was in the red, and this should show you that overall sentiment in the market has been quite negative over the past month. In fact, over the past few months, worst performing companies at this point in time in the group portfolio: Alcidion down over $2,000, Kogan down $2,000, and Zip down $2,300. Also, we have Pointera, Imogen Biosystems, Tesseract, Email Payments, Credit Intelligence, Xero, and Aries Resources, all down $1,000. And the main or common theme among all those companies down a lot of tech companies in there, only one mining company, and that is Aries Resources. And that's really what's happening now in the markets. Tech companies are being hit, while mining companies, because our commodity prices are going through the roof, seems like right now, mining companies is where you want to be right now in the market. Doesn't mean that's where you need to be for the long term, but that's just where we are right now in the cycle. Now let's have a look at how the group portfolio is performing or comparing to the overall market, we want to be outperforming the market. And right now, the group portfolio is actually underperforming the market, down at 1.81%, while the overall market, benchmarked by the STW, is up 1.15%. Now, no time to panic right now when it comes to this strategy, because from the start of the financial year to right now, the group portfolio has been outperforming the market. But because a fair bit of negative sentiment in the overall markets right now, a fair bit of volatility, that's why the group portfolio has been hit pretty hard. But when sentiment turns around, and it will eventually turn around, we will see the group portfolio start to outperform the overall market. And the main reason behind that is when you look at the overall market, or the ASX 200, the biggest companies in that tend to be mining companies and financial companies like the banks, and the majority of those companies haven't been hit too hard, particularly those mining companies. And that's why the STW, the ASX 200, hasn't been as significantly hit as other sectors within the ASX, particularly tech-focused sectors. And the group portfolio is heavily swayed or weighed towards tech. Not completely weighed in that way, because we do have, group portfolio does have investments in BHP, Woolworths, Fortescue, companies like that. So there is a nice little diversification in there, but it still is heavily swayed towards the tech sector. Now to my own personal portfolios, and yes, every company you see here is a company I actually do own in real life. Now this is my personal long-term buy and hold, and it has been struggling just like the group portfolio. In fact, I have been completely inactive within this portfolio. Perhaps I should have sold some companies, received $2,600 of dividends in the month, and that's all or mostly thanks to AVA Risk Group, $2,200, because they did give a capital return to shareholders because they did sell one of their divisions, and the share price fell away because of that capital return. The share price currently is 27 cents. So you saw the share price fall away a lot because of that capital return. So sort of balanced out. The capital gains went down a fair bit, but my dividends went up a lot as well. Current cash on hand, $31,241. And just like the group portfolio, not a lot of good news within this at all. And I'm just thankful I am up, because I did a fair bit of trading, selling some companies over the past 4 or 5 months. So I banked in a lot of profits. And that's why, even though right now the companies within this portfolio are down $11,800, I did make significant profits in those companies I did sell over the last 4 or 5 months. Best performing companies right now, EnviroSuite, Ansarada, Brainchip, Fiducian, and Sequoia. Not surprising, Fiducian and Sequoia are up there near the top because they are financial services company. And right down the bottom we have Zip, Electro Optics, Nanosonics, Cydev, Orbital Corp, Kogan, Clinuvel, and Xtech. I actually expect Xtech, Electro Optics, and Orbital Corp to potentially start to turn around, to start to see a bit of positive sentiment in those companies, because they are defense companies, and there is a possibility, potentially, particularly if the situation in Ukraine and Russia escalates, we could see a lot more spending in defense over the next 5 years. So I am quite hopeful that those 3 companies will see a potential shift in sentiment and share price trend over the next few months. Fingers crossed. If we continue to see a bit more negative sentiment continue in the markets, no doubt eventually my long-term portfolio will start to underperform the overall market. But right now, at the end of trading on March the 4th, the long-term portfolio is up 3.9%, which is favourable against the STW, which is up 1.15%. But if you look at the graph at the top, you can just see the performance of the long-term portfolio moving towards the STW. So again, if we continue to see negative sentiment in the market, I think eventually we will see my long-term portfolio start to underperform the market. Now to the performance of the strategy and portfolio, which I think eventually will be my most dominant strategy, because this is the sort of strategy that suits my personality. And this is using technical analysis, looking at sentiment and trend. And I should not be holding onto any companies that are in the red significantly. I will have companies in the red. For example, the worst performing company currently in the portfolio is CSL. Now, I do own CSL in my long-term portfolio as well, but I did decide to make a little bit of a trade, short-term trade with CSL. That's down about $300. Revison down $275. Babcorp down $245. Emerson Resources down $225. DGL Group down $200. So a few of those companies, in particular DGL Group, Prosper, IPD Group, I've only bought recently, but because of the overall negative sentiment, we have seen those companies' share price drop a little bit. But at the top end of the performance of these companies, South 32, my return in that is $4,153. So the share price actually more than doubled since I bought into that company. The share price of that company is in a well-defined uptrend. No reason to sell that company right now. It is a mining company, so a lot of tailwinds behind South 32. Second best performing company is Johns Lyng Group. That's up $2,500, almost a 75% gain in that company. The only reason I bought that company was it was in a long-term trend, a long-term uptrend, and share price had pulled back a little bit, and I just bought the dip with that company, even though when you look at the valuation metrics, it looks really overvalued. The share price keeps on increasing. And the third best performing company in this is OFX Group. Again, that was just based off a shift in sentiment, shift in trend, and the trend has continued for about, I think it was about 9 months. Fourth best performing companies is Capricorn Metals, a gold mining company. And the only reason I bought that is because the share price is in an uptrend, which was unusual at that point in time for gold companies. And the fifth best performing company is Neuron Pharmaceuticals. Now, to be honest with you, I think Neuron Pharmaceuticals should be in my long-term buy and hold because I think that has significant promise over the next 5 to 10 years. But I bought that because of a breakout in the share price. And the last performing or sixth best performing company is Lynas Rare Earths Group, and I bought that. A buy the dip opportunity, but again, that is a mining company. I recently bought that and it's already up $582. So again, you can see a few mining companies in the best performing companies within this portfolio. And that's what we're seeing in the overall market. Mining companies are doing fairly well right now because commodity prices are going through the roof, while tech companies are not performing. And one of the great things about this sort of strategy is when you see those shifts in sentiment, you see shifts in where people are investing in, for example, in mining, and they're getting out of tech. This sort of strategy will take advantage of that. So few tech companies right now within this strategy, this portfolio. So I already mentioned that I was fairly active in this portfolio over the past month. So a fair few buys and 4 sells. How many buys was that? Well over 10. So I bought quite a few mining companies. Metro Mining, because of the trend shifting sentiment. IPD Group, MRM, MMA Offshore, sort of another mining services company. That's all in boats, that sort of thing. DGL Group, Chemicals, Lynas Rare Earths, mining company. Mount Gibson, that is an iron ore. And if you have a look at the chart, that definitely looks like it could be breaking out, moving into uptrend. Prosper Group, based off their half yearly, it looks really good and really cheap at these prices. NRW, Mining Services Company, good half-year results. It looks like the share price could be breaking out. And same with Smart Group, really good half-yearly results. Looks like the share price could be breaking out. And finally, West African Resources, a gold company. A little bit of negative sentiment in that, but I do think gold prices have broken out. And because of that negative sentiment, because of a coup in Burkina Faso, I think the market was overreacting. I saw really good opportunities in that company, even though it does look like the share price is in a downtrend. I sold Magnus Energy, TPC consolidated. I've moved Vection Technologies to my long-term portfolio and sold out of TPG Telecom just because it was in a downtrend. 1 month ago, my short-term portfolio, my sentiment uptrend portfolio, whatever you want to call it, was the worst performing portfolios out of the 3. Now it's the best performing portfolio, up 5.84%. And ever since I started taking or paying more attention to this portfolio, it has outperformed the market significantly. So over about 5% outperformance in the overall market. And a lot of that outperformance has been done in the past 2 months. Now let's have a look at the performance of the 3 portfolios compared to the STW at the end of trading on 4th of March, also comparing to the performance at the end of trading on 4th of February, which is in the brackets here. So the STW ASX 200 at the 4th of February was actually down 0.04%, but it's now up 1.15%. And the reason why the STW is up over the past month, and especially when you compare to the group portfolio and my long-term portfolio, which are both down significantly, is just because mining companies and potentially even banks have actually done relatively well over the past month. However, when you look at the group portfolio, it's gone from being positive or up 10.2% to being down 1.8%. So a significant decrease in the overall performance in the group portfolio. And that's because of a massive lack of sentiment, positive sentiment in the tech sector. And if that continues, we might see the group portfolio still and continue to underperform the market. But if sentiment starts to shift, we will see the group portfolio start to outperform the overall market. The long-term, my personal long-term portfolio went from being positive or up 12.5% to being only up 3.9%, and very likewise to the group portfolio. As soon as we start to see sentiment shift around, that will start to outperform the market. Meanwhile, my short-term sentiment portfolio, and using that strategy, has gone from being up 3% to now up 5.84%. So a really nice return in that. That strategy is working right now. But in saying that, if we do see sentiment start to shift around, there is potential that a lot of the companies that are doing well in my short-term sentiment, a lot of the mining companies, will start to underperform, and that could hurt the performance of that portfolio and that strategy. So I have to keep that in mind as well. And right now, I am sort of hedging my bets. If we continue to see negativity in the world and markets continue to slide, that short-term sentiment portfolio will probably outperform the market in the other two portfolios. But if things start to turn around, we start to see positiveness come back into world, come into the markets, my short-term sentiment portfolio will start to underperform the other two portfolios. So it's all about sentiment, and that's the reason I've hedged my bets, because I have no idea which way it's going to go from here. Now, when I talk about my goals for March, to be honest with you, these were my goals for February. And one of my goals for February was to deploy short-term cash with patience. I've done that. I've actually deployed most of my short-term cash. So I can give that sort of a tick right there. Now, I'm not going to have a goal of deploying my long-term cash. I have over $30,000 there because I want to remain patient, because I don't know which way the market's going to go. And there's a lot of bearishness, lots of trends right now. Have a look at the DAX. The DAX has fallen off a cliff over the past week. Maybe I should do a video on that. So that is just telling us there's a lot of negative sentiment right now in the markets. And when there is negative sentiment, you just want to remain patient. There will be some people out there, experts, Scott Phillips is one, who always is 100% invested. And probably right now, he's trying to find good companies to invest. He believes that you cannot time the market. I sort of agree with that, but you can mitigate your risk. You definitely can do that. And you can't exactly time the markets. You can't exactly time the tops and bottoms, but you can time near the tops and near the bottoms. And that's what you do when you are or are able to be patient. Further develop my sentiment strategy, and this is something that is ongoing. I've developed a few more rules, or am developing a few more rules based off what sort of companies I want to use in this sentiment strategy. And one of the things I'm thinking about is excluding smaller companies, particularly illiquidly traded companies, from this sort of strategy. I want to focus mainly on big companies, profitable companies, those sort of companies, because what I've seen over the past year, or actually 18 months, is this sort of strategy works really well for those big profitable companies, but doesn't work quite as well for the smaller companies. Doesn't work quite as well when a mining exploring company releases some sort of good news. A lot of hype might come in, and that's not the sort of company I want to be using this strategy for. And that's going to evolve or continue to evolve over the next few years, hopefully. And eventually, I think I'll develop a really good strategy that will work for me. That's all I have for this 8-month performance update to the 3 portfolios, group portfolio and 2 of my own personal portfolios. If you do have any questions about anything I've mentioned in this video, just leave it in the comment section of this video. Otherwise, I'm not a financial advisor. If you do need financial advice, make sure you seek out someone who is qualified and can speak to your own financial needs. That's it for this video. Have a good day. Bye.